Today I want to explore a shift that almost no one is talking about in day-to-day financial commentary, but one that will have long-lasting effects on the global economy. It's not dramatic, it's not loud, and there are no headlines about it. But beneath the surface, something very deliberate is happening. Central banks around the world, particularly outside the traditional Western bloc, are rebuilding their reserves in a way that tells us far more about the future of the financial system than any short-term market move ever could. And interestingly, much of this behaviour is happening quietly, at high prices, and without any intention of turning a quick profit. What we are seeing is the return of gold as a strategic asset. Not because of hype and not because of panic, but because the global financial landscape is slowly becoming less predictable, more fragmented, and more politically sensitive. And in that environment, gold is once again becoming the world's preferred safe asset. Recent figures from the International Monetary Fund and the World Gold Council show that central banks purchased around 254 tons of gold in the first 10 months of 2025. That is a substantial figure, especially when measured against the already elevated buying in 2023 and 2024. What makes the number even more telling is that October 25 alone accounted for 53 tons, the strongest single month of official sector buying this year. This is unusual behaviour. When gold prices are high, central banks historically slow their purchases. But this time, they are not. And that tells us we're not dealing with price-sensitive accumulation. We're dealing with something strategic. When we look at who is buying, the picture becomes even clearer. The most active participants are not the traditional Western economies. They are the emerging and non-aligned nations who increasingly see the world through a multipolar lens. Poland has been the largest buyer so far in 2025, adding around 83 tons. The National Bank of Poland has openly stated an ambition to raise the share of gold in its national reserves to 30%. That's not a short-term trade. That is a structural rebalancing of national wealth. Kazakhstan has added roughly 41 tons. Much of that comes from domestic production. But the steady and consistent purchases suggest that gold remains a long-term anchor for the country's financial security. Kazakhstan's location and geopolitical balancing act make gold a natural hedge. Brazil has returned as a meaningful buyer, adding 31 tons across September and October after a long pause. When nations that have been absent from the market suddenly resume purchases, it almost always reflects a reassessment of global risks. Turkey has added around 27 tons, continuing its long pattern of building reserves during periods of uncertainty. For a country positioned between Europe, Asia, and the Middle East, gold plays a stabilizing role when currency or geopolitical risks rise. Now, China, at least officially, has reported increases of around 25 tons. But few analysts believe those numbers reflect the full picture. China's partial reporting and the fact that it can accumulate gold through channels that do not appear in the official IMF statistics mean actual purchases are likely higher. China has strong incentives to diversify away from assets that expose it to political or sanctions risk. Uzbekistan added around 9 tons, and the Czech Republic increased its holdings as part of a multi-year plan to reach 100 tons by 2028. So when you step back, the trend is unmistakable. The countries most active in buying gold are the ones seeking greater independence from the political and financial decisions of others. And it's not just the numbers that tell the story, it's the attitude behind them. A recent central bank survey revealed that roughly 95% of respondents expect global gold reserves to continue rising in the years ahead. That is almost unanimous recognition that gold still plays a vital role in national security, financial stability, and long-term planning. Gold is the only reserve asset in the world that carries no counterparty risk, cannot be printed, cannot be defaulted on. And unlike currencies or sovereign bonds, it cannot be frozen or seized through financial sanctions. For countries navigating an increasingly unpredictable world, those characteristics are becoming more important and not less. Part of this shift is about diversification away from the US dollar. Not in the dramatic and often exaggerated sense of abandoning the dollar, but in the much more realistic sense of reducing over-reliance on a single reserve asset. Most central banks recognize that the dollar will remain dominant for many years, but they also recognize the rising geopolitical and macroeconomic risks associated with holding too much exposure to one currency. Another part of the story is the decline in appetite for long-dated government debt. Many nations are running large fiscal deficits. Debt to GDP ratios are rising, and questions about long-term sustainability are becoming harder to ignore. For a central bank, shifting a portion of reserves into gold is a straightforward way of reducing vulnerability to future debt instability. Then there is also the issue of sanctions. Over the past decade, financial sanctions have become a more widely used tool in geopolitics. This has made many countries, especially those outside Western alliances, reconsider what safe reserves really mean. Gold is immune to the political risks attached to foreign-held currency reserves. What is particularly important is that this behavior is not coming from panic. It is not coming from a sense of imminent crisis. It is coming from long-term strategic planning. These nations are preparing for a different kind of global financial environment, one where influence is more distributed, where alliances shift more rapidly, and where economic power is less centralized. Gold becomes the neutral asset in a world that is no longer economically or politically uniform. So what does all this mean for ordinary investors? It doesn't mean the gold price is going to surge dramatically overnight. And it certainly doesn't mean gold replaces every other asset class. What it does mean is that gold's role in the global system is strengthening. Not because of retail speculation or short-term trading, but because the foundations of the financial world are changing slowly and quietly. Central bank purchases provide a level of stability that is very different from private investment flows. They create a long-term floor under the market. They reduce the likelihood of deep, prolonged price corrections, and they tell us that gold will remain relevant, perhaps even increasingly relevant in the years ahead. For the individual investor, gold's value is not in predicting dramatic spikes, but in recognizing its role as a stabilizer within a broader portfolio. Gold doesn't pay dividends and it doesn't generate income, but it does preserve purchasing power across long periods of uncertainty. And that is precisely why the world's central banks continue to buy it. The global economy is entering a period of structural transition. New technologies, shifting alliances, rising debt levels, and the reconfiguration of global power all feed into an environment where nations want assets that sit outside political influence and financial fragility. Gold has filled that role for thousands of years, and quietly, without much attention, it is doing it again. If you found this breakdown helpful, feel free to subscribe to the channel for more calm, clear analysis of the forces shaping money and power today. I post regularly on the big structural trends that rarely get discussed in the headlines, but increasingly shape the financial world we all live in. Thank you for watching, and I look forward to seeing you again in the next video.